Well, welcome back from lunch, everyone. We're going to talk a little bit about FINRA perspectives in this next session for about 50 minutes. Just by way of introduction, my name's Sarah Kenny. I'm a director in the Office of Financial and Operational Policy, which is a mouthful, at FINRA. And I'm joined today by Anthony Vinci.
Hi, everybody. Sorry I couldn't be there in person due to the weather in Chicago last night. My flight out of New York City was not delayed, but outright canceled. So I'm here with you remotely with Sarah. I know you're in good hands there in person. So we're going to attempt to do this in a hybrid manner.
Yes. So let's talk about what we're going to address today. So we're going to go over some hot topics, some recent regulatory guidance we wanted to make you aware of. We're going to talk about everyone's favorite topic. I know it's Anthony's favorite topic, which is exemption reports. And then we're going to talk about some FINRA oversight observations and some references with FAQs and key hot topics pages. So let's dive right into it.
Yeah.
For those of you on the phone, the CPE code, or you could probably actually, is 741, so 741.
And as everyone's getting that code down, right before we get into the hot topics, first of all, I just want to thank the PCOB and their staff for having us today and always including us in their forums. We find them to be very useful in terms of trying to get information out to the auditors, which is critical for us, being that we're one of the key users of the financial statements for the broker-dealers. Just a little bit of background for those that aren't familiar. So myself and Sarah work in the Office of Financial and Operational Risk Policy, which is embedded in our Office of General Counsel. Although Sarah does have her law degree, I do not, and most of us in the group do not. We're kind of the legal-ish people for the financial numbers or the financial responsibility rules. But we provide the FinOp policy guidance on SEC and FINRA financial responsibility rules and U.S. GAAP to internal staff and member firms. So basically, we internally at FINRA, we kind of own the FinOp rule set, right? So when it comes to rulemaking for FINRA, so some of you may have seen like the liquidity risk management proposal that was put out a couple years back, and that's still pending. And when it comes to implementing some of the new SEC rules, which Sarah will get into a couple of those that are timely, we're kind of on the front lines with that and interacting with the Division of Trading and Markets at the SEC. Just in general, in terms of FINRA's structure, so similar to the PCAOB, we're a self-regulatory organization. We are funded by our broker-dealer member firms. And, we have a number of different functions. So, our mission is investor protection and market integrity. But, we have a number of different divisions. So we have our member supervision division, which monitors broker-dealers and registered reps for compliance with FINRA and federal securities laws. That's mostly made up of your risk monitoring function. The risk monitoring analysts are typically the first point of contact for each of our firms. So every one of our broker-dealer firms has an assigned risk monitoring analyst they can reach out to with questions, or that analyst will reach out to if they have questions about these reports or anything else about the operations of the firm. We have a cycle examination function. We also have a national fraud and fraud investigation division. On the market regulation side, which is kind of removed from what we do, what Sarah and I do, and probably for what those in this audience would be involved in, but just as a high level, oversees the trading activity across the U.S. securities markets to detect fraud and manipulation. We do have an enforcement arm that investigates and takes disciplinary action against firms and individuals who violate securities rules and laws. We have Office of General Counsel, which is, I would say the main function there is really the rulemaking function, since FINRA does have its own rule book. Credentialing, what we call credentialing, registration, education, and disclosure. We love acronyms too. Handles all the licensing, exams, disclosures for industry professionals. So your Series 7, your 24, your 27, all those good numbers. Those are all administered by FINRA. We have a dispute resolution services arm that administers arbitration and mediation between investors, firms, and brokers. And as some of you may have seen from some of our reg notices, publications, and even podcasts, We have technology operations and strategies groups that support FINRA's regulatory functions through data analytics and technological advancements like generative AI. Here, the agenda, just in general, Sarah will kick us off with some hot topics. We'll go through some recent reg notices. We'll go through some items that were important from the regulatory oversight report that was published by us a few months ago, back in January. And then everyone will have access to the deck. There's some resources in the back for FAQs and key topic pages. And obviously, if there are any questions, we're happy to address them as well. So I will hand it back over to Sarah to get us going.
Great. And before we start, we've got a number. I know we have a bunch of people logged in virtually, but we do have a number of people in person here with me. Can I just get a show of hands? Who here is an auditor of broker-dealers? Okay, so a good number. And then from broker-dealers themselves, regulators, and other, right? Okay, well, just for full disclosure, I am a recently departed auditor myself, as some people in the audience know, and so that's why I just wanted to get an understanding of the mix of the audience. So today, we're going to talk about a few things, and I hope I'm not stealing the SEC's thunder as they're the next session, but the SEC, the daily 3-3 computation rule, the electronic filing rule, then Anthony's going to take underwriting syndicate communications, and then segment disclosures, which is a fairly new development for the 2024 year end. So let's kick this off. So the daily computation rule was approved in December of 2024, and what that requires is that any broker dealer with what it currently requires, and I'm emphasizing that on purpose. So what it currently requires is any broker dealer with average total credits equal to or greater than 500 million to move to a daily computation of 15c3-3 and the requisite deposit the next business day if the reserve formula indicates a deposit is needed. The current the SEC estimates that approximately 49 firms will be affected, 9 of which are already doing daily computations. So 40 firms will be newly into this. So how do you determine the threshold, that 500 million? So first of all, it's the sum of both customer and PAB credits, and it's based on a rolling 12 months of the previous 12 monthly filed focuses. The initial measurement period, sort of when do we start, how do we put a stake in the ground, currently is filings from June 30th, 2024 to July 31st, 2025. So based upon that rolling period, then a firm would determine whether they are initially in scope for this move to daily computation. And then if they meet that threshold, they would have to begin daily computations no later than 12/31/2025. There is some guidance about firms that if you initially meet the scope, but then you fall below the line, you're below the threshold, then you're back in the threshold. There is guidance about how you handle that, but that is going to be assumed to be a very limited audience of broker-dealers that are going to be hovering right around that threshold period to period. So if you are in the daily computation space, one benefit is that you get to reduce the haircut on the debit side from 3% to 2%. So if you are required to do the daily computation, you get that benefit. So because there is a benefit on the debit side, there are firms that may not be required to adopt, but may want to voluntarily do a daily 3-3 computation. And so if a firm wants to voluntarily opt in to get the advantage of the 2%, they may, of course, do that. If they do it daily, they must continue to do it daily until they notify FINRA and they approve for that firm to go back to weekly. So if a firm opts in to do it voluntarily, they may do so. But you can't just flip-flop back and forth, do it daily for a month, do it monthly for 3 more months, and back and forth. So if you opt in voluntarily to get the advantage on the debit side, you want your firms to be pretty sure that they're going to have the resources and the ability to do it daily on a go-forward basis. And I think, obviously, this is an editorial comment of my own, not FINRA. There's a lot of operational and resource strain when you're doing something daily that was previously weekly. So I wanted just to come back to, I said I emphasized the word currently. We do understand, and perhaps the SEC will speak to this in their session, that they have received requests to delay the compliance date. We understand they're considering this. There are also some mechanical questions around how do you handle money in motion, how do you treat money in motion, so there's not a punitive deposit requirement. They're also considering those, but nothing official has come out yet on that topic. So that is Daily 3.3. I'm not sure, Anthony, if you had anything to add to that?
Yeah, the only thing I would add to that is just from the auditor's perspective, just speaking to the extent that you have clients that this would impact, thinking about internal controls over compliance and the compliance report and what the implications there would be, right? So even, especially in kind of the nuanced scenario of maybe the firm's not required to adopt this, but they do anyway, because to Sarah's point, they want the 2%, they want to reduce the buffer they need to put in their account from 3% to 2%, which could be pretty substantial, especially for some of the larger firms. And what that means for the compliance report during the year, right? How the firm is setting up their policies and procedures, how they're setting up their internal controls. So those are definitely things to just stay aware of. Also, frankly, we're currently in a world where even as rules become effective and final, anything can change, right? So I would just say, keep an eye on, some of the communications from the SEC over the next few months in case anything that, frankly, we're sharing with you now could very well end up being outdated 3 weeks from now or a month from now, right? So just kind of keeping a finger on the pulse there.
Okay, great. Well, then that's a good segue to the next topic, which is the electronic filing rule. So again, in December was a busy month. The SEC adopted the proposed rule for electronic filing submission of certain materials and changes to the focus. So it is not solely a broker-dealer rule, but it's broker-dealers because it affects filings made under 17A5, amongst other rules. Amongst other things, it will require broker-dealers to file its annual audits to the SEC electronically. So right now, the current state is a broker-dealer may opt in to filing electronically, and many do, but it is still acceptable to file paper submissions to the SEC. Once this rule reaches its compliance date, which we'll get to in a second, there will be no option to issue a paper annual audit. It will all have to be electronic. And although that may sound benign, there are a number of things to think about in terms of what that implication is if your firm, if your broker-dealer or your client currently files paper. So there is no scope out of smaller firms. There was some comments when the rule was proposed to give relief to smaller broker-dealers. There is no scope out. It also clarified, this is not new, but it clarified that electronic signatures on documents is okay. And it also, and this is a nuance, but I think it's important, it relieves firms of the requirement to obtain notarizations on the oath and affirmation because the electronic filing has built-in safeguards around identity verification. And so there's no need to have a notarized oath and affirmation. It does not change the requirement to have an oath or an affirmation. It just changes the requirement to have it notarized. Again, because of the inherent verification checks. So, like I said previously, electronic filing was permitted but not required, and the oath and affirmation was required to be notarized. So this rule was published in the Federal Register with an effective date of March 24th, 2025. The compliance is required for audits filed after June 30th, 2025. So the rule, and again, I'm going to come back to this in a second, the rule was effective in March, But if you have a March 31st broker-dealer and you're going to file it the the end of May, they would not be required to comply with this. It is audits filed, not year ends, audits filed after June 30th, 2025. So a couple of points to note. Again, it sounds benign, but there's lots of discussion around this. There was an executive order that was issued after the rule was approved with the new administration that basically said that regulators have the ability to potentially scale back anything that was issued in the previous few months. So there is a little bit of lack of clarity whether this rule actually is effective. However, it is in the Federal Register and the CFR. So I believe, again, my editorial comment, I would work as if it is effective with that compliance date. Another point to note, which may, again, be logistic, but it could catch people out. In order to do this, the firm needs to create a login.gov sign-in by September 15th, 2025. That would be the way that they effect this electronic submission. So if there's a firm that currently does let's say they're a 12/31 year end, so they won't have to file an annual report until next March 1st, right? March 1st of 2026. Don't think that they don't have to think about this before then, because they have to create this login ID, and I think there's some concern that there'll be a sort of an oh my God moment at filing deadlines March 1st next year, that people are locked out of these systems to be able to actually make the filings. And again, this is the electronic filing to the SEC. The FINRA gateway remains unchanged, but we just wanted to make you aware of the change because of those logistics and because there is a population out there that continue to file hard copy. So those are the two SEC rules. I think I'm going to hand it to Anthony to take the underwriting syndicate communications.
Great, thanks, Sarah. Yeah, the one thing before I get to underwriting syndicate communications with the electronic filing rule is, although the SEC has clarified that electronic signatures are acceptable, they also outline what some of the requirements will be around that. So I would definitely take a look at that, because it's not just about you can copy and paste a signature. Like I believe there has to be a timestamp, and there has to be some sort of like a digital certification that's involved. So definitely take a look at that with your clients, because that will be important and something that's looked at closely. In terms of underwriting syndicate communication, so in general, just kind of taking a step back, one hot topic that usually stays on the list is related to net capital charges around open contractual commitments, right? So, in terms of equity or debt underwritings, often we observe firms that run into issues of having insufficient capital for underwriting participations, whether they're the lead or whether they're just part of the syndicate. So they're failing to capture whether it's the correct kind of numerical net capital charge, but also the timing of it, right? So when they have to start to take the charge and when it actually gets released or comes off. And we often see a lack of documentation to evidence when an open contractual commitment charge is actually released. So one thing that we wanted to just create some awareness around is that on January 10th of 2025, SIFMA actually published a syndicate communication on the open contractual commitment for registered debt offerings. So FINRA worked with SIFMA on that to develop kind of that template communication that is publicly available. And that's something that a manager in a registered offering could send to other members of the syndicate to provide documentation that FINRA deems sufficient for syndicate members to remove their open contractual commitment charge for that offering. So that template is just that. It's a template. It is it's industry guidance, so it's voluntary. You don't have to use that template. And each underwriter, they have to make their own determination with respect to the use or reliance on the template. But the one thing I will add is that when you look at the template, it talks about registered debt offerings, because I believe that's something that SIFMA was looking to specifically address. However, we view this as this could be applied to equity offerings, this could be applied to municipal offerings, It's not, in our view, the template wouldn't just apply strictly to registered debt offerings. So just something to keep in mind there. The next item I'll take is related to segment disclosure. So, we usually don't love bringing up accounting issues, especially at the PCOB forum, right? It's not really our area, but it is something that has come up on our radar over the last couple of months, right? So related to the new segment disclosure annual report requirements. So as many of you are likely aware, in November of 23, the FASB published ASU 2023-07, updating the segment reporting ASC 280 to make improvements to reportable segment disclosures. In part, that amendment clarified that all broker-dealers who file reports with the SEC meet the definition of a public business entity and must apply the guidance related to those disclosures. And the compliance date for broker-dealers for fiscal years beginning after December 31st of 2023, right? So it applied for the 2024 year. So some of the things we're observing with our firms is we've gotten a number of questions or comments from broker-dealer firms, most specifically the smaller firms, that believe that they are not a public business entity by definition. We're pretty comfortable saying definitively, especially since in the FASB release, I think they talk about non-issuer broker-dealers or broker-dealers that are not public companies being in the scope of a public business entity. So there have been a number of firms that have stated, well, I'm not a public company, so I'm not a public business entity. That does not have the same definition across, right? So this does apply to all of our broker-dealers that file an annual report with the SEC. So those are some of the conversations, foundational conversations we've had with broker-dealer firms. We've seen some annual reports, and it's early to have really good statistics on this just yet, because as you could appreciate, a number of firms are on the automatic 30-day extension, which means they just filed like yesterday. And that is, a good chunk of our firms that filed, within the last couple of days. So we're still kind of reviewing. But for some of the reports that have come in, we have seen instances where there is absolutely no segment disclosure, or there's an incomplete disclosure. So for example, it may say, the chief operating decision maker looks at the P&L of the firm. Right. It's like, well, they don't say who the CODM is, though, right? Who the chief operating decision maker is. So we're talking about really kind of fundamental things that we're seeing that have not been there. Elephant in the room. So if we get a report that this year that does not have the segment disclosure or has an inadequate disclosure, we are not looking to reject that report. What we have instructed our risk monitoring analysts to do is to have a conversation with the firm to help educate them and point them to the right resources so that they can get this right for next year. And that obviously they should be discussing this with their auditors as well, right, from now, so that they could plan for next year. But FINRA is not looking, assuming no other issues, of course, with the annual report that's been submitted. If the only issue with the report was that there was a missing or inadequate segment disclosure, we would not, on that basis, reject the annual report for 2024. So that's a big statement, but that's an important one to put out there. So we hope the next time we can meet with you guys, we hope to have a little bit more context around that. But that's kind of where we are right now.
Right. And just two more points on the segment piece. Anthony mentioned that there was confusion about applicability to broker-dealers. And I frankly understand confusing public business entity with a public company. They're different. So there was a confusion about whether the broker-dealers were in scope. They clearly are. But also some broker-dealers said, we don't have segments. We are one segment. We're a single segment. So we have nothing to disclose. That's also not true. You still have to disclose who the chief operating decision maker is and other things. And just as an FYI, the FASB has put out an invitation to comment about the definition of public business entities to see if they should remove, and they specifically mentioned non-issuer broker-dealers from that definition. So there is an open invitation to comment if any of the any folks out here or your firms feel like they want to advocate for removing broker-dealers. Obviously, being a public business entity generally leads to earlier adoption times for new FASB pronouncements and usually more disclosure. Segments is an example of one that would completely go away. So I just wanted to mention that. Okay, just wanted to make you aware of some recent regulatory guidance that FINRA has put out. So FINRA currently has an invitation to comment on modernizing rules to be more efficient and reduce costs. And the comment period ends May 19th, 2025. So that's out there. That is out there right now. We wanted just to mention we had issued a regulatory notice relating to the California wildfires that granted relief for a number of broker-dealer functions, such as forwarding checks, filing focuses, other types of filings. That was issued in January, but that has expired. It expired in March. So if you had a firm that was taking advantage of that relief, that relief has now expired. We also issued a regulatory notice around unexpected close of securities markets. So think of a national day of mourning for President Carter. How do you treat that when you're counting days to, file the focus or the annual report or a number of different things? So that's written generically, not specifically for Carter. So it will be used anytime there is an unexpected close of the security markets. We also, back in November, published the due dates for all of 2025 and first quarter 2026 for focus and annual report filings. We did also in 2024 publish some updated interps on margin rules and then some amendments just to conform our rules to T+1 settlement cycle. So if any of those are relevant to you, they're on the FINRA website and you could read all about them. CPE code is 463. I don't see any questions coming in, so I'll continue. And it is not forwarding for me. Is there any? Oh, no, wait, hold on. I think I was just too fast on the trigger.
You gave away all the code.
I know. It's still okay. I'm gonna be patient. Oh my goodness. Here we go. Okay. No presentation is complete without talking about exemption reports. So understanding, let's talk a little bit about the background. As many of you are aware, there's been a historical sort of deferred maintenance in the exemption report department related to what exemptions firms that don't clearly fall into one of the K exemptions, what they should be doing. And I believe up until fairly recently, the focus only allowed you to check one of the boxes that referenced a K exemption. So there's been a number of pieces of guidance that were issued relating to exemption and compliance, going back to the FAQs that have been out there for, I think, close to a decade, and then some specific FAQs relating to the exemption report itself. So we pointed you. Let's just talk about this conceptually as I flip page to the next page of my notes. So when a broker-dealer is filing its exemption report, or actually let me step back. A broker-dealer's membership agreement is what the broker-dealer is approved to do. The broker-dealer's exemption report is what the broker-dealer actually did during the year. And it is possible that, first of all, they don't fit into a K exemption at all, or it is also possible that a broker-dealer has multiple business lines that fall into multiple exemptions and or relief from filing a compliance report, right? So you have K1, you have K2 prompt transmittal, you have K2II, which, clearing on a fully disclosed basis. And so think about it in a couple of categories when you're thinking about a broker-dealer's business. The firms whose activities fall into a K exemption are considered covered firms. And in their exemption report, if all you are is a K2I or K2II, the broker-dealer makes a statement, we claim exemption under K2I, K2II, And we met that exemption without exception throughout the year, or as follows. We failed to promptly transmit 7 checks in the month of January and 8 checks in the month of February, et cetera, et cetera. So if a firm is under a K umbrella, that is what their exemption report looks like. However, there are a number of firms that they're not carrying firms, but they don't meet one of the covered functions. They're not a covered firm, so they're a non-covered firm. And so the SEC, as many of you know, granted relief first through footnote 74, which allowed firms that did not meet the exemption provisions to not have to do a compliance report, because as you know, a compliance report is pretty, it involves a lot more, to say that. So if you are footnote 74, you do not fit a K exemption, but you are granted this relief from filing a compliance report. And footnote 74 is what's called self-operative, which means if you fit the footnote, then you do not have to request permission from the SEC, you just are. You just are footnote 74. However, that exemption report, or that portion of the exemption report, looks different because a firm that's claiming relief under footnote 74 has to actually name the business activities that they do, and then also state that they did not hold or otherwise incur securities or funds for customers, or they promptly transmitted it. They didn't carry accounts for customers. They didn't carry proprietary broker-dealer accounts. This is all laid out in the footnote. And then on top of that, there's also footnote 78. So this is for broker-dealers with extremely limited custodial activity, meaning they are holding checks temporarily that are made out to a third party for very limited periods of time. They can seek exemptive relief. So the distinction there is that footnote 78 is not self-operative. A firm has to get approval from the SEC to use it. And so their report also looks different because they're not referencing a K exemption. And so then you have firms that may be all of the above. It's like a multiple choice question. A, B, C, all of the above, some of the above. And so if there's a firm that is doing activities that fit into these different exemptions and different relief, then all of that needs to be described in the report, not just the one they do the most, not the one that they primarily are. It would be anything they did during the year. So it's quite likely, and we see a lot of questions around, is this exemption report fully descriptive of the type of business that this broker-dealer does? And so we wanted to raise it to all of you because this sort of deferred maintenance is still ongoing, and it is a source of lots of discussion and question that we see on our side about what the exemption report should look like. So I'll stop there, Anthony. I know you're the expert, but if you want to jump in on anything I missed, go right ahead.
No, I think that sums it up pretty well. What I would say at a high level is, there are templates out there, again, industry guidance, right? I believe it's on both SIFMA and the AICPA website that provides like 4 scenarios of exemption reports. So, you're under one or more exemptions, you're under one exemption, you're under, 2 exemptions. Those are the 2 scenarios. You're a footnote 74 firm, what I'll call like a pure firm, or you have some combination of exemptions and footnote 74. So those should be helpful. And if you feel like you don't really fit into those buckets, or you get into this de minimis custodial activity, footnote 74 type activity, I would suggest having your client or your broker-dealer firm speak to their risk monitoring analyst to make sure that the basis on which that they are filing their exemption report is, would be appropriate.
Okay, great. So that's exemption reports. CPE code is 947. 947.
All right.
So Anthony, you want to talk about the FINRA annual regulatory report?
Absolutely. So in January, FINRA put out the 2025 FINRA Annual Regulatory Oversight Report. I think this report's been renamed at least 3 times in the last 5 years, but it typically gets published, around the same time every year. For those that are pretty diligent about looking at this year to year and you just want to know what changed, we do put in bold in the report what changed or what's been added to the report anyway. So for this group, I think the financial management section is likely the most relevant. However, there are probably a couple others that you might want to take a look at as well. But in the financial management section, updates are in bold to talk about net capital, liquidity risk management, and then segregation and protection of customer assets. So, a lot of it wasn't really I wouldn't say that the observations in the financial management section were necessarily new by any stretch, but I do think that there were a number of items that were reframed. They were reframed and emphasized. So, for example, Reg Notice 2321, which we had put out, it was a little bit more than a year ago, maybe a year and a half almost ago, in December, that talked about the net capital and record-keeping implications of improper revenue recognition under ASC 606, right? So that is something that's pretty prominent in that section of the report and talks about making sure you have documentation around your revenue recognition policies and procedures, actually have a policy, have documentation, have analysis, especially at the small firms where there's M&A activity. This is where we're seeing broker-dealer firms get tripped up the most on this type of thing. Especially around retainer fee structures and assuming that that's material, and when those can be recognized, whether they're recognized up front, over time, at the end of the period. So that is something that I have to say it's quieted down, I think, on that front from our perspective over the last year or so, but it is still something that our examination folks are looking at because it has proven to have some material net capital implications for firms. The report, or that section of the report, also talks about inadequate supervision, which is kind of a different angle to some issues that we've been seeing already. But this was inadequate supervision around the process for determining when a firm has a net capital deficiency and has to suspend operations, right? So obviously no firm is really going to want to have to plan for if and when they have a deficiency or when they would have to suspend their operations, if that were the case. But that is that's a statutory obligation that if you have a net capital deficiency, that you do have to stop doing business, securities business, and you do have to make a timely notice filing as well. So that is something, every time we see something, whether it be small scale or larger, something quote unquote kind of go wrong, those tend to be, the first few hurdles that firms have to get over. We also talk about insufficient capital for underwriting participations. I know I talked about that a little bit earlier with the template, but in terms of the report, it talks about acting as a lead underwriter without maintaining sufficient net capital for open contractual commitment charges, or just inaccurate open contractual commitment charges, failure to capture or only capture the day of pricing or settlement, and not on the unsold portion from pricing through settlement, and just applying the wrong percentage in some cases. So open contractual commitments is definitely still a focus of ours as well. When it comes to customer protection in 15C3.3, we've seen inadequate supervision for reserve computations. So some of the things that we've seen lack of supervision around has been the customer versus non-customer coding in systems, a failure to identify and track aged suspense items, and a failure to ensure that bank sweep programs are compliant. So in terms of bank sweeps, one thing that I'll give it as an example, we've seen in more than one instance where a bank sweep program offered by a broker-dealer, where free credits of the customer of that broker-dealer are swept into a bank sweep program. We've seen instances where not all of the banks that are participating banks are FDIC insured. So maybe it's a foreign bank. 15C3.3 specifies that bank sweep programs all the banks that participate in bank sweep programs have to be FDIC insured. So that has been an issue that's come up. Frankly, that's a pretty big one. So I would say if your firms are doing providing bank sweep programs for their clients or for their customers, that is something to kind of keep an eye on. We've also seen inadequate understanding of relevant requirements under customer protection. Usually a lot of that has to do with possession or control, and it also tends to be in some of the more, what I'll call like the more technical or the more nuanced areas at some of the larger, more complex firms when it comes to securities lending, where you can kind of run into some issues there in terms of whether you're providing collateral to customers and how that's being handled. Those can be kind of tricky issues to kind of have to deal with. Not detecting or resolving coding errors that result in inaccurate credit and debit balances, and overall just inadequate handling of customer checks, where we've seen where maybe there's no prompt forwarding process at all. We've seen where firms have, going back to the exemption report for a moment, we've seen exemption reports where, not promptly forwarding checks. We've seen firms that report exceptions that are a handful, a few hundred, a few thousand, right? And that, you have to take that in context, of course, right? Because depending on the size of the firm, if you had 1,000 checks, but, there were 100,000 checks that were forwarded during the year, right? You have to kind of put that in perspective a little bit. But it does, obviously, I think you could appreciate that it's going to raise questions on the FINRA side in terms of why that's happening, if there's some process or just systemic issue there. So that is something that continues to come up there. The other section of the report that I would highlight is that there is a new section on third-party risk landscape under firm operations section. It talks about, what to do about key systems and cybersecurity events. So there's been, as you can imagine, we put a lot of literature out on cybersecurity, so you can take a look at that on the website. That section also talks about artificial intelligence, the continuing and emerging trends that we're seeing. It does reference Reg Notice 2409, which talked about or reminded member firms, broker-dealer firms, of their regulatory obligations in using generative AI and large language models. So, I know that's on the forefront for really everybody in the industry. And, I talk about the industry more kind of big picture in general, right? The securities industry, across the financial reporting landscape. That is something that is a big focus. A couple other items that I'll just touch on that not necessarily are highlighted in big bold letters in the report, but are items that we still are always getting into discussions with. And I am looking at the time. I know we started a few minutes later than the schedule, so maybe we'll just go like 3 more minutes. Expense sharing agreements. So when it comes to expense sharing agreements, notice to members 0363. It's an old one, but it's still kind of the Bible for that topic. So I would just, making sure that your clients are looking at that, making sure that, to the extent that they are allocating expenses to their broker-dealers from, say, a parent company, that they do have an allocation methodology, that they do have documentation, that they do have an expense sharing agreement to start, right? That allocation is reasonable and it's being applied on a consistent basis. That's pretty important as well. So there's, we often get into discussions around that. There's 0363 is pretty long, frankly. Frankly, it's a little bit painful every time I read it because I feel like I pick up something that I didn't pick up before, and it makes my head hurt a little bit. But the reasonable allocation really is key, right? So they talk about a reasonable allocation as one that attempts to equate the proportional cost of a service to the proportional use or benefit derived from the service. Right, and then so really you need to have some sort of documented evidence of what that reasonableness is, right? So that is, that is something that is important. There's also interpretation in the 15C31 interpretation manual, which is on the FINRA website. It talks about services agreement with a parent or an affiliate, where if you do not have enough documentation for a payment that's been made by a broker-dealer to a parent or an affiliate, even if it's called a services arrangement, it could be presumed to be a capital withdrawal, which obviously would have other permanency of capital implications and notification implications as well. So just something to kind of stay aware of. I think that's about it for this one.
Great. CPE code, excuse me, is 577. And then we just wanted to direct you, I'm not going to go through these, which probably is to great relief to everyone on the phone and in the audience. But we have some FAQs and key topic pages. Again, you'll have the deck, so you can look at these, but our FAQs and then a number of key topics around select areas like crypto and fintech and annual reports. I did want to quickly we got two questions that I think we can get through quickly. The first one is, if there is a non-covered firm who files a compliance report but has multiple revenue streams, and some of those streams fall under K2I or K2II, would they also need to file an exemption report, or would the compliance report cover them? So it is a one or the other. So actually the way that the rule reads, it says if you did not claim exemption throughout the period, you file a compliance report. Right? And so if any of your activities require you to do 3.3 and you are not exempt from it, you do a compliance report. If you also have activities that, if those compliance report activities didn't exist, you could do an exemption report. You don't have to supplement it with an exemption report to kind of fill the bucket. You would be in the compliance report world. So no one has to file two. It's one or the other based on if any activity you have requires you to compute 3.3, i.e. not be exempt from 3.3. The second question is a two-parter. Can you expand on what types of activity is intended to go under K2I, and also expand on how to be compliant with commission recapture? So K2I, like Anthony said, is when you are receiving customer checks, but you are promptly transmitting them, which is by noon of the next business day, and you're effectuating customer transactions through a special account for the exclusive benefit of customers, or an EBOC account. And so that's what sits under K2 single I. Commission recapture, we do understand that and acknowledge that there is a discussion around where does commission recapture fit, since it is money that is going to be paid back to customers, and does that put a company that does commission recapture as part of their business or their whole business, does that put them in compliance world? I know there is extended discussion about this, and we would recommend that whomever asked that have their broker-dealer firm reach out to their RMA at FINRA and come to OFORP, which is mine and Anthony's group, to talk about it further. So those were the two questions we had online. I know we're up against time. If there are any in the audience, happy to spend 30 seconds or... Okay, so that's all I see on the screen. So with that, thank you for your attention and for being here and listening in online. And I will close out and hand it back to Brian. Thank you.
Thanks, everybody.